You know that moment when you're scrolling through listings at 2 a.m., calculator in one hand, coffee in the other, wondering if that $250,000 property will actually cash flow, or if you're about to become a landlord who bleeds money every month? Here's the thing. Tens of thousands of investors right now are asking the exact same question, and most of them are getting the math catastrophically wrong. We're gonna crack open the rent-to-price formula that separates profitable real estate portfolios from financial disasters. You'll discover why the 1% rule is both brilliantly simple and dangerously misleading, what actual market data reveals about realistic rent expectations, and the hidden variables that make or break your return on investment. Let's start with the elephant in the room. That $250,000 house doesn't exist in a vacuum. The city you're in, the neighborhood you're targeting, even the street corner matters more than almost anything else when projecting rental income. If we're talking about markets like Cleveland or Indianapolis, that $250,000 investment might snag you a renovated 3-bedroom pulling in $2,000 to $2,400 monthly. But drop that same cash in San Francisco or Manhattan, and you're lucky to afford a parking space. Forget about rental income. The classic 1% rule suggests you should target monthly rent equal to 1% of purchase price, which would mean $2,500 for our hypothetical property. It's a decent starting point, a back-of-napkin filter that works surprisingly well across diverse markets until it doesn't. Here's where reality gets messy. Most markets today are hovering between 0.5 and 0.8%, meaning that $250,000 house, realistically, rents for $1,250 to $2,000 in average American cities. The 1% rule has become more aspirational fantasy than operational guideline in 2025. But wait, before you close this tab thinking real estate is dead, let's inject some perspective. Remember 2008 when everyone declared residential investment was finished, only to watch savvy investors build generational wealth during the recovery? The psychological roller coaster of real estate cycles is absolutely brutal. One month, you're reading headlines about housing shortages and rent surges. The next, you're drowning in stories about remote work, killing urban real estate, and demographic shifts cratering demand. Here's what the data actually shows. Rental vacancy rates nationally sit around 6 to 7%. Median rents have climbed roughly 4% annually over the past decade, and housing inventory remains constrained in most metropolitan areas. These aren't opinions or hot takes, they're stubborn facts that persist regardless of headline hysteria. I'll be honest with you, I missed the boat on several markets between 2010 and 2015 because I was paralyzed by analysis. Everyone was screaming about another bubble, and I sat there running spreadsheets while prices doubled. The lesson wasn't to throw caution away, it was to understand that real estate operates in predictable cycles even when each crash feels uniquely terrifying. Prices rise, speculation enters, affordability suffers, demand softens, prices correct, smart money enters, and the cycle begins again. Your $250,000 property question fits perfectly into this framework. If you're in a tertiary market with strong fundamentals, job growth, population influx, limited new construction, that investment could generate $1,500 to $2,000 monthly at a reasonable 0.6 to 0.8% rate. Now let's demolish some dangerous myths. First, you don't need positive cash flow from day one to build wealth through real estate appreciation and mortgage paydown matter enormously. Second misconception, higher rent always equals better investment. A property generating $3,000 monthly in rent but requiring $4,000 in expenses and debt service is objectively worse than one pulling $1,500 with $1,200 in total costs. The third myth that destroys novice investors: you can accurately predict rent without studying actual comparables. You can't. Every neighborhood has micro variations that render national averages useless for specific property evaluation. Here's your practical playbook. Research comparable rentals within half a mile of your target property, adjust for condition and amenities, factor in realistic vacancy rates of 5 to 8% annually, and calculate all-in costs, including maintenance, property management, insurance, taxes, and mortgage. Only then do you know if the numbers work. Position sizing matters more than market timing. Putting 20% down on one property you can afford to hold through downturns beats leveraging yourself to the eyeballs on 5 properties that force a distressed sale during the next correction. This isn't about courage or conviction, it's about mathematics and discipline. The investor who survives owns the market eventually. The over-leveraged genius who timed the bottom perfectly but couldn't hold loses everything. Think about real estate as a long-duration game where consistency compounds. A modest 0.6% rent-to-price ratio maintained for 20 years with steady appreciation and mortgage reduction creates more wealth than chasing the mythical 1.2% deal that never materializes. Here's the philosophical truth nobody wants to hear. Your success depends less on finding the perfect property than on executing an imperfect plan with discipline. The $250,000 house generating $1,800 monthly might not look sexy on paper, but held for a decade, it transforms into equity, cash flow, and optionality. I'm personally comfortable whether your market delivers 0.5 or 0.9% rent ratios because I've built systems that work across that range. The key is knowing your numbers, maintaining reserves, and avoiding emotional decisions when headlines scream panic. Real estate remains one of the most accessible wealth-building tools available to ordinary people. While stocks require you to compete against algorithms and institutional traders, rental properties reward research, patience, and operational execution skills anyone can develop. The beauty of residential real estate investment is its tangible, controllable nature. You can improve your returns through renovations, better tenant screening, or management efficiency in ways impossible with passive investments. Yes, markets fluctuate and vacancy happens, and tenants occasionally trash properties, but the fundamental shortage of housing in desirable areas isn't disappearing. People need places to live, and that creates enduring demand for competent landlords. Your $250,000 investment, properly underwritten and located in a market with solid fundamentals, should generate somewhere between $1,200 and $2,400 monthly, depending on your specific city. That range isn't vague, it's honest acknowledgement that location drives everything. If you're serious about exploring investment properties across different markets and price points, check out www.growthsense.com, a straightforward directory connecting investors with residential and commercial opportunities nationwide. You can browse listings, compare markets, and even list your own investment properties completely free. It's not complicated software or some guru's paid community, just a simple, transparent platform helping investors find deals and sellers reach buyers. Whether you're hunting for that perfect $250,000 cash flowing property or looking to offload an asset, www.growthsense.com strips away the noise and gets you focused on what matters: the numbers, the location, and the deal itself. Thank you for sticking with me through this deep dive. If this helped clarify the rent expectations puzzle, drop a comment sharing your market and what you're seeing locally. Real estate investing works best as a community effort where we share data, challenge assumptions, and help each other avoid expensive mistakes.